All right, so today we're zeroing in on a company that constantly pops up on the radar for income-seeking investors, TXNM Energy. Now, on the surface, this utility stock looks like an absolute dream, right? Like this totally reliable engine of wealth generation. But in this explainer, we aren't just going to stand around admiring the shiny paint job. Oh no, we're popping the hood, we're peeling back the layers, and we're launching a full-on investigation into the true financial health of TXNM Energy. We're going to rely on nothing but the raw data to separate the neat little narrative from the actual reality. So let's dive right in.
14. That is 14 straight years TNMM Energy has bumped up its dividend payout. Now, if you're out there building a portfolio that's geared toward passive income, a number like that is a massive hook. It screams stability. It suggests you've got this predictable management team totally committed to rewarding shareholders year in and year out, no matter if we're in a bull or bear market. And let's be real, a 14-year streak, that's not an accident. It takes some serious, consistent financial engineering to pull that off. It is exactly the kind of shiny metric that makes you just want to buy the stock and completely forget about it.
But wait a minute. As focused learners, we can't just take a shiny headline like that and run with it, right? Which brings us to the absolute most critical question we have to ask today. Is that payout actually safe? Because a streak, at the end of the day, is just a record of the past. It is absolutely not a guarantee of the future. So we're going to look way past that glossy 14-year surface and dig deep into the raw underlying data. We need to figure out what is actually funding those checks, and whether this company's financial foundation is anywhere near as sturdy as that dividend streak implies.
Now, when we look at the yearly returns over the last decade, wow, it has definitely not been a smooth, straight line up. Notice the intense volatility going on here. I mean, in 2024 and 2025, the stock posted these spectacular gains of nearly 23% and over 23%. And even with a modest 2% projected for 2026, the historical ride has been incredibly bumpy. Just look at 2023, a super painful drop of almost 12%. And you see a really similar pattern if you jump back to 2019's massive 26% gain, which was immediately followed by negative returns in both 2020 and 2021. So the big takeaway here is that while the dividend increases have been steady as a rock, the actual day-to-day experience for shareholders has been a total roller coaster. But hey, credit where credit is due, right? Despite all that crazy turbulence we just talked about, for the iron-stomached investors who actually held on for the long haul, the historical resilience of this stock has paid off big time. A 15-year total return of 494.02% is just phenomenal. And remember, that figure rolls in both the stock price appreciation and the reinvestment of those constantly growing dividends. It tells this incredibly powerful story of long-term compounding. If you bought into this a decade and a half ago, you are probably very happy with TNN Energy right now.
So why the massive return? It really comes down to the compound annual growth rate, or CAGR, of those dividends. Over a 5-year period, they've actually managed to grow the dividend by an average of 5.23% every single year. Over 3 years, it's 4.75%, and over the trailing 12 months, it sits at 3.66%. This totally validates that surface-level appeal we talked about. Not only are you getting paid, but your paycheck from the company has been consistently beating or pacing historical inflation over these time frames. Honestly, from this angle, it looks like a perfectly healthy, thriving utility company.
Okay, but here's where things get really interesting, and honestly, a little scary. 117.73%. That is TXNM Energy's current dividend payout ratio. I really want that to sink in for a second. The payout ratio measures the exact percentage of a company's net income that gets paid out to shareholders as dividends. So anything over 100% means the company is literally handing out more cash to shareholders than it is actually earning in profit. Let me say that again. They are reaching beyond their actual earnings just to keep that 14-year dividend streak alive. Suddenly, that amazing streak looks a lot less like a badge of honor and a whole lot more like a massive financial burden.
So what's going on under the hood to cause a payout ratio to get so dangerously high? Well, let's contrast these two figures. Over the last 5 years, TXNM's revenue, meaning the total money coming in the front door, has grown by a really healthy 7.29% annually. They are successfully selling more power, which is great. But look at the net income growth, negative 2.61%. This exposes a severe problem with the company's financial engine. They're bringing in significantly more top-line revenue, but they're somehow keeping less and less of it as actual bottom-line profit. The sheer costs of doing business are basically eating their gains alive.
To really grasp how fast this is squeezing them, we just have to look at the trailing 12 months, or TTM, data. The company pulled in a massive $2.166 billion in revenue. Huge number, right? Yet their net income for that exact same period was a measly $151.36 million. And even more alarming is that bottom figure.
The net income compound annual growth rate over the last 12 months has absolutely plummeted by negative 37.49%. That completely puts this profitability squeeze into perspective. The profit margin is just thinning out so rapidly, and that directly threatens their ability to fund any future dividend payments from their actual operations.
All right, let's shift gears and talk about the price tag layer of our analysis. What are investors actually paying for this business right now? Well, the price-to-earnings, or PE ratio, is sitting at a lofty 40.83, alongside pretty elevated price-to-sales at 2.98 and price-to-book multiples at 1.89. Now, for a utility company, which is a sector traditionally known for slow, steady growth and way lower valuations, a PE hovering near 41 is exceptionally high. You really have to stop and ask yourself, are elevated multiples like these actually justified? Especially when you factor in the shrinking profits and that massive drop in recent net income we just uncovered.
And just to put that price tag into perspective, TXNM's current PE ratio is over 40% higher than its own 5-year historical average. So not only is the valuation super high relative to the broader utility sector, it is massively inflated compared to the company's own historical norms. Think about that. Today's investors are paying a significant premium for a stock whose fundamental profitability is actively going down. You are literally paying top dollar to get less actual earning power. It's kind of like paying full sticker price for a luxury car, only to pop the hood and find out the engine is missing.
Now, before we get to the absolute biggest red flag in this entire explainer, let's make sure we're completely aligned on one crucial term: free cash flow, or FCF. This is the absolute lifeblood of any business. It's the actual tangible cash a company has left over after it's paid for all of its operating expenses, keeping the lights on, and its capital expenditures like maintaining or upgrading its power grids. Free cash flow is the money that can actually be safely used to pay down debt, buy back stock, or, most importantly for us today, pay out dividends.
Negative $611.4 million. That is TXNM Energy's trailing 12-month free cash flow. I'll let that sink in for a second. After paying their day-to-day operating expenses and their necessary capital expenditures, they are in the hole by over $500 million. They are just bleeding cash. When a company has negative free cash flow of this magnitude, it means there's absolutely no way they can fund their dividends from their ongoing business operations. The money just simply isn't there.
So naturally, that massive deficit translates directly into some pretty brutal metrics. We're looking at a free cash flow yield of negative 9.46%. And because they literally have zero free cash flow, their FCF payout ratio is effectively maxed out. This fact completely shatters that optimistic dividend growth story we looked at earlier. I mean, if you aren't generating cash, how on earth do you keep paying a growing dividend? The answer is simple, and it's usually pretty painful. You either have to go borrow money, or you have to issue new stock, which just waters down the value of existing shares. They are stretching themselves incredibly thin just to maintain appearances.
And that brings us to the very bedrock of our investigation: debt and liquidity. Their debt-to-equity ratio is 1.65, which tells us they are already heavily reliant on borrowing. But the true red flags here are the liquidity metrics. The current ratio sits at 0.55 and the quick ratio is at 0.38. In the financial world, anything under 1.0 means a company does not have enough liquid cash or assets on hand to cover its short-term liabilities. So let's tally this up. They have high debt, massively negative cash flow, and virtually zero financial breathing room to handle any kind of sudden economic shock.
So it all boils down to this one massive question. With high debt, practically non-existent short-term liquidity, plunging net income, and a free cash flow deficit of over $600 million, how long can this 14-year dividend streak actually last? We've peeled the onion today, and we've seen the raw numbers beneath that shiny surface. And the data strongly suggests that without a monumental turnaround in operational efficiency, something eventually has to give. I really hope this explainer has empowered you with the tools to look past the headlines and dig into the data for yourself. Thank you so much for joining me on this deep dive today, and I highly encourage you to take these numbers, run with them, and keep researching.